to Iron Financial. Look, right now we are operating in a market that is constantly teetering on macroeconomic uncertainty. Volatility is out there, literally stripping the paint right off of these overvalued equities. And because of that, absolutely everyone is suddenly looking toward the legacy tech giants, searching for some semblance of stability. I'm your lead analyst, and our mission here on this channel is incredibly simple. We are here to help you forge a stronger, significantly more resilient portfolio, and we're going to help you cut straight through the market weakness. Today, we are conducting a rigorous, no-holds-barred structural inspection of Apple's Q2 2026 earnings explainer.
And I'm the market skeptic. I am sitting here to ask the tough questions, the exact questions you're actually thinking about at home. We've pulled the raw filings, we've got the 10Qs, the 8Ks, and the full earnings call transcripts. No fluff today, just the ironclad data. We need to figure out, is this company actually as invincible as the broader market prices it to be? Or are we, as investors, conveniently ignoring some very serious, potentially fatal structural flaws buried deep down in the foundation?
All right, let's just bring the hammer down immediately with the absolute sheer weight of this top-line number. For the fiscal second quarter, ended March 28, 2026, Apple posted a staggering quarterly revenue of $111.2 billion. Let that sink in for a second. That is a massive 17% increase year over year. I really want you to think about the literal scale of that figure. This single 90-day revenue print, it's larger than the gross domestic product of several developed nations. Actually, scratch that. It entirely outpaces the total market capitalization of legendary legacy companies that have been operating for well over a century. We are not talking about some nimble, small-cap tech stock that's just finding its footing in the market. We are talking about the single most established corporate structure on the entire planet, and they are somehow accelerating their top-line growth by 17% in a mere 3 months. Right, I hear you, and the sheer size of $111.2 billion is absolutely blinding. But my job here is to ask, is this hype or is it actually real? Is this massive revenue surge just some AI-fueled mirage catching the temporary tailwinds of a much broader tech euphoria? Or is this a structurally sound financial fortress that is genuinely built to last? Because let's be honest, a 17% top-line jump for a company of this immense, unprecedented magnitude simply does not happen by accident. It is either a temporary structural anomaly that's currently masking some underlying fatigue, or they have genuinely fundamentally found an entirely new gear in their business model. Lead Analyst, Section 1, the drill down, top-line power. And figuring that out is exactly what we are going to do right now. It's time to transition into the heavy lifting of the income statement. I promised you a no-nonsense breakdown of the raw metrics, and that means we have to look far past that flashy headline revenue. We need to see exactly how efficiently that cash is actually flowing down into the true foundation of the business, the bottom line. Now, just to briefly ground this discussion, Apple's historical market dominance is obviously legendary. This specific company is the undisputed bedrock of countless index funds, pension plans, and everyday retail portfolios all around the globe. But as we always say here at Iron Financial, history does not pay future dividends. So we have to drill straight into the current quarterly filings. We are examining the financial blueprint they literally just filed with the SEC to see if the concrete is still curing properly or if it's maybe beginning to crumble under its own immense weight. The year-over-year comparison is exactly where this story gets aggressively bullish. In Q2 of 2025, they posted $95.3 billion in revenue. Fast forward to Q2 2026, and we are staring at that $111.2 billion figure. But here is the absolutely critical metric that every single structural investor needs to highlight right now: diluted earnings per share. It went from $1.65 up to $2.01. That is a 22% EPS growth, outstripping the 17% revenue growth. Net income hit an incredible $29.57 billion for the exact same quarter. This conclusively proves that the company is not just lazily growing its top line, it is actively accelerating its core profitability. Through some really intense margin expansion and aggressive calculated capital management, they are squeezing noticeably more profit out of every single dollar that enters their ecosystem. Market Skeptic, Section 2, the load-bearing pillars. Okay, I cannot argue with a 22% jump in EPS. That is solid. But what exactly is holding up this $11.5 billion structure? Because if one of the core load-bearing pillars is showing signs of stress behind the drywall, the whole building could eventually be at risk of a cave-in. We really need to shift our focus to the segment analysis and see exactly where this cash is originating.
Let's look at the actual architecture of Apple's revenue. The iPhone is still overwhelmingly the primary load-bearing pillar here. It pulled in $56.99 billion. That is up from $46.8 billion a year ago, a massive 21.7% jump fueled directly by the new iPhone 17 lineup. But right next to it, holding up the other side of the roof, is the reinforced steel of the services division, sitting at a completely unprecedented, all-time record of $30.97 billion. Meanwhile, you've got Mac coming in at $8.39 billion, wearables at $7.90 billion, and iPad at $6.91 billion. Look at the balance there. The entire trillion-dollar operation is overwhelmingly supported by just two segments, the iPhone and services.
So I have to push for clarity on the why here. We can clearly see the top-line numbers, but what are the specific internal drivers doing the heavy lifting for this 17% overall growth? What's the engine?
The specific catalysts are blatantly clear when you read the filings. First off, Tim Cook explicitly cited extraordinary global demand for the new iPhone 17 lineup. And you know, it isn't just the premium high-end models. The targeted rollout of the iPhone 17e specifically captured fresh, net new market share in emerging regions that were previously just entirely priced out of the iOS ecosystem. Second, the services sector isn't just growing by some happy accident. It is being aggressively driven by App Store revenue, a massive, undeniable expansion in enterprise and consumer cloud services, and real, compounding strength in their advertising business. When you dig into advertising, you realize that's incredibly high-margin revenue essentially built entirely on top of their existing ecosystem infrastructure. Furthermore, they saw double-digit growth across every single geographic segment: Europe, the Americas, Greater China. The demand is structurally sound and truly diversified across the entire globe.
And this leads us directly to a crucial structural pivot that every single serious investor must understand. Apple's services segment, sitting at nearly $31 billion, now comfortably outpaces the combined total revenue of the Mac, iPad, and wearables divisions, which only totaled just over $23 billion. This is a monumental, fundamental shift in the company's DNA. Services provide a highly predictable, high-margin, recurring revenue base. If you run the actual numbers from the 8K filing, services operate at a staggering 76.6% gross margin. Compare that to the 38.6% margin on their hardware products. Think about what that means. It means services is practically printing pure free cash flow. They completely bypass the expensive global logistics, the raw material costs, and the absolute assembly headaches of building physical hardware. Services isn't just a pillar, it is the high-grade titanium of this entire portfolio. Market Skeptic, Section 3, Finding Cracks in the Armor. All right, I think we've had enough of the bull case. It is time for me to play the pragmatic building inspector. I am actively tapping the walls right now to expose the underlying weaknesses because absolutely no $371 billion balance sheet is without its deep flaws. Let's look really closely at where this structure might actually be compromised. If we pull up the historical filings, specifically the Q1 2026 10Q from the December quarter, we saw legitimate, undeniable bleeding in the hardware segments. Mac revenue actually dropped 7% in that quarter, down to $8.38 billion from $8.98 billion the year before. Wearables also fell 2%. Now, in this current Q2 report, Mac has slightly recovered to $8.39 billion, and wearables sits at $7.90 billion. But let's call it what it is. That is basically stagnation at best. We have to ask ourselves, are these fatal wounds to the broader ecosystem, or are they just scratches? Because right now, we are dealing with significantly longer consumer upgrade cycles and severe macroeconomic tightening. Everyday consumers are holding onto their laptops and watches longer. If absolutely everything outside of the flagship iPhone is struggling to find any meaningful growth, that is a massive structural imbalance, just waiting to snap.
And listen, the internal hardware weakness isn't even the only issue. The foundation is under a massive external siege right now. The legal history here genuinely reads like a multinational rap sheet. In March 2024, the Department of Justice filed a sweeping antitrust lawsuit claiming monopolization of the entire smartphone market. Fast forward to April 2025, and the European Commission slapped them with a staggering €500 million fine over Digital Markets Act violations regarding App Store steering. Then in December 2025, the Ninth Circuit Court upheld the Epic Games injunction, permanently forcing Apple to allow external payment links. And looming right on the horizon is the EU's Article 6.4 investigation, which could carry devastating fines of up to 10% of their global net sales. Honestly, at this point, their corporate defense lawyers might literally be the only segment with a higher growth rate than the iPhone. This is a massive regulatory wrecking ball aimed directly at their highest margin pillar, services.
Furthermore, Apple's own executive team is standing right there throwing up warning signs. In their Q3 June quarter outlook, they are projecting 14 to 17% revenue growth. Sounds great, right? but they explicitly warned on the earnings call that this projection represents their best view of constrained supply. We are currently in the dead center of an ongoing, brutal global memory shortage. Essential DRAM and NAND components are being swallowed whole by the massive, insatiable surge in global AI infrastructure demand. Literally every tech giant is fighting tooth and nail for the exact same chips. Because Apple requires such a massive manufacturing scale, even a slight hiccup in global memory supply chains completely bottlenecks their entire Q3 revenue projection. Can Apple's vaunted supply chain truly withstand this kind of stress? Or will raw material shortages put a hard, unbreakable ceiling on their ability to actually build and sell those highly demanded iPhone 17?
Section 4. The bedrock. Cash and buybacks.
Those are entirely valid stress tests, I will give you that. But let me counter those warnings by shifting our focus back down to the absolute bedrock. You can tap the drywall all you want, you can point out the regulatory fines and the supply chain bottlenecks until you're blue in the face. But when you look at the foundation beneath the surface, the sheer financial bedrock supporting Apple's valuation is practically impenetrable. We need to talk about cash flow. The crucial point is exactly this number right here, $28 billion. That is the operating cash flow generated in just the March quarter alone. Over roughly 90 days, their core business activities pumped out $28 billion in pure, usable cash. This isn't accounting magic. It's not unrealized paper gains. This is real, highly liquid cash entering their bank accounts. That is the ultimate liquid concrete filling any structural cracks you just pointed out. It gives them the unmatched heavyweight ability to effortlessly pay off massive EU fines, heavily adapt their supply chains, and invest in heavy hardware R&D without ever needing to take on a single dollar of toxic, high-interest debt. And because their free cash flow is so incredibly vast, their board of directors just authorized an additional share repurchase program of up to $100 billion. Let me be perfectly clear about what this means structurally for your portfolio. A $100 billion buyback is literally larger than the total market cap of the vast majority of companies currently sitting in the S&P 500. This acts as a massive internal reinforcement. It is an artificial concrete floor built right under the stock price. By taking that cash and permanently removing outstanding shares from the open market, they artificially concentrate the earnings per share for every single remaining investor. The denominator shrinks, so the value of your piece of the pie mathematically increases, completely regardless of the macro conditions outside. In fact, during the first quarter of 2026 alone, they already repurchased roughly $25 billion of common stock. They are aggressively, systematically protecting your downside. Let's quickly review the complete, finalized shareholder return metrics. We have the new $100 billion share repurchase authorization acting as a structural shield. On top of that, they just declared a cash dividend of 27 cents per share, which is a very solid 4% increase, payable on May 14th, 2026.
Market skeptic. Look, I have to admit, it is incredibly hard to argue with a machine that can effectively just buy its way out of trouble. Despite the very real legal siege happening in Europe, and despite the glaring hardware stagnation we are seeing in Macs and wearables, the company's foundational ability to reliably generate and actively return capital to shareholders is, without a doubt, absolutely ironclad.
Section 5. The verdict. Opportunity or trap. Okay, we have laid out the blueprints, we have carefully inspected the load-bearing walls, and we have clearly identified the systemic cracks. It's time for the final verdict. We need to synthesize all this raw data and deliver a completely no-nonsense assessment for the retail investor listening to us right now. Let's put the bull and bear case side by side. My one-sentence pitch for the bull case is built on undeniable, overwhelming power. You are looking at $111.2 billion in quarterly revenue, an EPS explosion of 22%, an all-time record in high-margin services, and the ultimate, impenetrable safety net of a $100 billion buyback. It's a fortress, plain and simple.
Market skeptic. But my one-sentence pitch for the bear case demands your respect. This company is fighting a brutal, multi-front global regulatory war that directly threatens the core profitability of the App Store. Their secondary hardware segments are showing undeniable signs of consumer fatigue, and they are openly warning us about global memory supply constraints that could completely choke off their projected Q3 production.
So, we leave you with this final, truly provocative thought. You have seen the raw metrics, you clearly understand the raw strength of the pillars holding this up, and you know exactly where the cracks in the drywall are hiding. Is this the unbreakable foundation of your portfolio, ready to actively compound your wealth for the next decade? Or is the mounting regulatory pressure and hardware stagnation pointing to a premium-priced value trap that is just waiting to cave in under the massive weight of its own expectations?
Use these iron financial metrics, look at the blueprints yourself, and make your decisive market move. Thanks for joining us for this explainer, and we will absolutely see you on the next inspection. Keep building.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.